CEO and President of Charter School Capital, and excited to be here today along with Dick Ward to talk about facilities options for charter schools, and particularly today we're going to do a deep dive on the bond market and opportunities there for charters. We're going to cover a number of things, but before we get going, I want to introduce Dick, the Senior Vice President of Dougherty and Company, and Dick and I have worked together for really almost the last decade on a lot of different efforts between his organization and ours, getting money to charters. But as a pioneer in the industry, I think Dick has really done some amazing things. Dick, welcome aboard, and happy to have you with us today. Can you tell everybody about some of your background and expertise, that so people know the brilliance that will be exposed to them today?
Absolutely. Thanks, Stuart. It's a pleasure to be involved today and welcomed by the group here. First and foremost, my name is Dick Ward. I work for Dougherty and Company. We're a registered broker-dealer and have been operating in the tax-exempt bond market for the last 40 years. Privately held company based in Minnesota, home of the first charter school in the country, but we operate in the charter space around the country. And I do have to acknowledge for the group, when we get to page 29, you'll see a disclaimer from Dougherty as an underwriting firm. We're very, very pleased to participate today. I am, but we need to disclaim any information we have today and that's shared is not advice. We act as an underwriter in the marketplace, not a municipal advisor or financial advisor. So for the listeners, we're really pleased to be sharing information for your benefit, but you need to know, as far as disclaimer, that we act as an underwriter, not only for charter schools, but for other tax-exempt issuers. And then just quickly, as Stuart mentioned, my practice has actually been with charters since the very beginning. I think we did one of the first tax-exempt bond transactions in the country in Minnesota in 1998, and that movement has grown along with other opportunities for financing that we're going to talk about today. So we're very pleased to be involved in the charter sector and help the movement to continue its growth path.
Thanks, Dick. We at Charter School Capital have not been around as long. It's excited to have somebody who's been there since the beginning and done some of the things that you've done. At Charter School Capital, as many of you know, we've been around since 2006. Started funding schools 2007. Today we've funded over 500 charter schools, now operating in 15 states across the country, and as of this month have crossed the $1.5 billion mark in funds provided to schools. So we also surpassed the 600,000 student mark, which is exciting for us in terms of the support everybody's been able to provide. But today, Dick and I are going to walk through some insights about facilities financing, and I think given what's going on in the market today, we'll talk a little bit about what's happening in the financial markets and the impact on potential funding and financing for your charter. Some thoughts from us today on understanding and choosing a funding structure that works for your charter school, the balance between the dreams of what your facility might look like versus the realities of budget constraints. Key things to think about in terms of getting approved for funding with any organization, and then some additional considerations regarding project execution, timing, and other things to think about as you consider financing and execution of a facility that can serve your students. Throughout the presentation, don't worry about doing screenshots or anything like that. The entire presentation is available for download afterwards, and the link here at the bottom of the page is charterschoolcapital.org/webinars, and as part of this presentation, and when you get the download, there's contact information for Dick and for us if you have follow-up questions. During the session today, if you do have questions, the GoToMeeting application allows you to type in those questions for us. If they're not covered by the material, we'll try to answer them as we go along. But please feel free to type in anything you'd like us to react to as we go, and we'll run for about an hour, and hopefully you'll find it insightful. That said, what's going on today in the market? Facilities is one of the biggest challenges that charter schools face, having access to them, reliable access and stable access to facilities that serve your students. It's one of the biggest obstacles to growth in the market. But even with that constraint, the market has grown significantly. When we started, there were 1.2 million students when we funded our first school at the end of 2007. Today, there are over 3 million students being served by charters across the country in 44 states, if you include the District of Columbia. And there are still over 1 million kids on waiting lists for those schools, which primarily is a function of not enough seats to welcome those kids into the building. Over 7,000 charters now in the U.S., many of which are constrained by facilities. And unlike how it was when Dick did one of the first tax-exempt bond issuances for a charter school organization, as he mentioned in '98, today there are a lot of options for charters for facilities financing and funding, which would allow charters to continue to grow and expand enrollment. In today's environment, interest rates have really come down quite a bit over the last decade, but while money is cheaper than it's been, the recent disruptions in the market, Dick will talk about briefly or in a moment, associated with the presidential election, and rates have been rising now for the last year or so, and the Federal Reserve is expected to increase rates even further in the very near term. As a result, thinking about long-term financing and or refinancing to lock in lower rates if you have old rates, or get funding now can be a good idea, particularly getting long-term financing in place in a rising rate environment. But as you think about things from your school, whether you're a CMO or an EMO or an individual school operating independently, whether you're thinking about refinancing an existing financial structure or expanding in growth, the options available for your school vary, and the structures have different elements to them, whether it's a long-term lease or funding direct with a bank or the bond market, all things to think about. Dick, do you want to comment on really anything here, but particularly about what's going on in the market today? I know we're going to get into it more.
Yeah, just a quick comment on that piece. We've seen some, frankly, in all interest rate markets, we've seen some rapid changes as a direct result of the election, which probably held some changed expectations. Having said all that, our markets move daily, and in general, we're certainly in an interest rate environment that has to be considered historically low. Stuart, I think your comments are fair about a trend upward. If we look at economics in the U.S. and projections, including the Fed, looking at changes, it is likely going forward we're going to have increases in interest rates. That should be a reasonable expectation, but it's a good and attractive market now, and we expect it to continue that way, even though there may be trends upward.
But given a rising rate environment, getting into some sort of long-term fixed financing can be useful. if that's the expectation. So let's talk about some of the options or considerations for a school looking into facilities financing or modifying, expanding, or moving from their existing facility. So things to think about as a school. On the one hand, actually, I guess, look at the right side of this chart. What is it that you need? It varies depending on what your academic mission is, what your growth plans are, short-term, medium-term, long-term, in terms of enrollment. If you have any specialty requirements, there are charter schools out there that serve primarily special needs kids. That may be very different than a dropout recovery organization that needs, to have very flexible schedules, or a charter school that's focused on the arts, which may need really fantastic drama facility or music room or what have you, or a charter school focused on athletics may need totally different fields, facilities, gymnasiums, etc. So thinking about those specialty requirements for your academic program is important. And there may be local considerations that have to do with zoning requirements, laws, expectations, or other things you have to provide in terms of what's required for your facility that are unique to your school. On the other hand, that has to be compared against, well, what can your organization afford? And that's a function of your existing cash reserves, the ongoing percentage of revenue that you want to commit to paying for debt service or your lease payments, the fundraising available to you, either subsidies from the state, federal, or local governments, or private fundraising options who may be interested in subsidizing or donating funds to your organization, and then the different creative funding alternatives, some of which we'll cover today, can drive how much you can afford to deliver against those specific requirements.
And Stuart, I think we're gonna drill down a little bit on the one of the metrics, as we would call it, the percentage of revenue available, allowed, and here's your slide, making sense for any financing vehicle. So we'll have some comments on that now.
I think that's right, and I think schools often come in to us, and I know to you, and say, well, hey, how much money can we get? And it's really a function of what the organization can support long term. And so this chart here gives you an idea for your school. It's a way to analyze at a high level how much you can afford in terms of land, building space, what have you. And the y-axis or vertical axis here shows potential project budget. You can see rises from 0 to 20 million in this chart, and then that's charted against annual school revenue. So the project budget is what you could afford, and then it's a function of what your ongoing annual revenues will be. And as you see across that horizontal axis, it moves from 0 to 10 million a year. And this is just an example, but these three different lines, the gold line on the chart, or lower diagonal line, assumes a 10% commitment of your ongoing revenues to paying for your facilities. And that's again, debt service payments or your lease payments. The gray line is 15%, and the green line is 20%. And in our experience, and we'll get into this as we go, for any and all options, whether it's a long-term lease or the bond or bank financing or any other execution, going above 20% tends to be problematic for schools over the long haul, because there's not enough available to continue to invest in an academic program that can remain competitive with the other alternatives. That said, you'd like to do it for as little as possible, and in many markets, 10% is something that is readily accessible. But if you use this chart as an example, follow along from left to right, and you see the $6 million of annual school revenue, if you wanted to spend 10%, you would end up with a project that was about $6 million. And if you were spending 20% of annual revenue, you end up with a project that could be as much as $12 million. All this varies depending on cost of funding and things like that, but it gives you an idea of expectations of ballpark what you can afford. Dick, you want to add to thoughts on this chart?
I think this is a really helpful illustration for schools and operators. And if you think about it, if you think about facility costs as a threshold of your whole operation, that 20% number is very realistic in terms of a threshold, a maximum for any type of financing or any lender or funder that you're going to be talking to. And the main reason for that is all of us in the business understand clearly, for you as operators, the majority of your revenues need to go for education, staffing, and those requirements. So the facility costs do need to be bound by some reasonable measurements. So, Stuart, I think this is a great illustration of how that flows through, particularly against schools in terms of their own operating scale. So the only thing I would add is, on a relative basis, when you're looking at, and obviously a lot of schools that are looking for financing are going to be on the smaller scale on scope. So when you look at a smaller operator, a smaller annual budget in the $2 to $4 million range, one thing to be aware of and sensitive to is that 20% of that number actually gets to be a little bit more challenging than a lower threshold. So to your comment, it's all relative to specifics of any financing option that's available, but I think this is a really good illustration for users to kind of get their hands around the core thresholds.
As we're going through these things, one of the questions that's come in relates to what revenue is used to consider, whether it's the individual school or if you're part of a charter management organization network, can the CMO or EMO's network be considered? And the answer is that absolutely those additional revenues can be considered. Most financing sources will look long-term to make sure the individual underlying school entity or that unit can stand on its own, but definitely the revenues of the overall CMO or EMO, if they end up being the debtor or the tenant contractually, can really provide significant credit enhancement and is welcomed by investors and absolutely can be considered. Though I'd say, and I'd ask you, Dick, if you see it the same way, still the individual unit economics of the school need to work. In other words, if really you're building a building and the long-term capacity of that building would only allow you to have, essentially be spending 40% of the revenue for that school on that building, that's still unlikely to work, even if you have a creditor, a borrower that could afford it. It doesn't really look like it makes sense. But to have something in year 1 or 2 that's very high with expectations of being able to fill the building over time, then definitely that's something you can transition into, and the CMO's revenues can be really valuable there and help get a project funded earlier on that might not be fundable by itself. Anything you'd add there on that? We'll get into more of that when you start talking through the bond economics. Dick.
Indeed.
Okay. So let's back up here to given the affordability issues, let's transition in what are the options available. And so when you look at this picture here, a core message that we want schools and school leaders to understand is that as the size of the financing, either the size of your operations, organizations, the revenue streams, or really just the total dollars that you're trying to raise or that you need committed for the project increases, and the number of years of operation or your maturity as an organization increases, the options available to a school for funding for facilities increase significantly. So you get out, you're doing a $25 million financing for a school that's been around 10 years and has had its charter renewed a couple of times. You really have a lot of alternatives as an organization. If you're a startup school that's an independent operator that just got its charter, is in year 0, you haven't even opened your doors, and you're going to have 100 kids, or you hope to have 100 kids, the options are very limited. But generally, when you're looking at this picture that we have here, on the left side, going from small to large, the bottom of the chart is small schools or small funding, and large transaction at the top. That's that vertical axis, and on the horizontal axis, number of years of operation, moving from 0, pre-revenue kind of startup organization to a 10-year plus organization. You can see how things expand. These midpoints are not the midpoints on some numbers, but they're examples of where there are inflection points that create other opportunities. In the upper right-hand quadrant, for a more mature organization and larger financings, bonds become an option. And Dick will get into this in more detail, but beginning around $10 million, and you can certainly do a bond for lower than $10 million, but the economics get less attractive to the school, and there are fewer parties interested in working on those bond financings given the complexity. But beginning at about $10 million and above, bonds really become an option. And for schools that have achieved their first charter renewal, that becomes an option. Prior to that, either smaller than that size or prior to first renewal, other alternatives exist in the market, including, if you read along these quadrants, for small early stage schools, most charters get a short-term lease from an existing landlord for an existing property to get going, whether that's a local church or an empty office building or what have you. And they don't do that because that's what they want or desire long-term, but it's sort of the only thing you can get. Today, there are actually developers with access to different forms of capital that we work with, who are willing to commit to and build out or acquire properties for schools that allow them to enter into a long-term lease that can give you control of your facility long-term, but can get you rolling even when you're early on. And so those options are available now. Once upon a time in the charter school market, they weren't. As you move out in terms of maturity, banks can provide local, community banks, regional banks, and some national banks are funding directly some charter schools, but there, as we'll get into it, you may need to have some cash or, equity available that you're contributing to the project, which may or may not be available to the school. And on the other hand, if you go up to the upper left-hand quadrant here, for large transactions above 10 million, developers and long-term leases are much more prevalent. People generally feel that the larger organization is, the more likely it is to be sustainable. Dick, you want to add to this and talk about the dynamics of the various alternatives available, and particularly, when bonds become a viable option?
What I think I'd add here, Stuart, is that I think this gives a really good illustration of kind of the whole marketplace itself, if you will. Whether we like it or not, we all fit in a box somewhere, and as an operator, we're probably going to move between these boxes over time. The really good news from our perspective, and I think yours, is there are financing options whichever environment you fall in now. So for an example, very fair to discuss a bond transaction fitting best and being most efficient generally for larger 10 million or above, and for more mature schools, and even in some circumstances having a first renewal of a charter contract would be kind of a minimum criteria to come to the bond market and access capital. And that's not necessarily true for every operator, every project. So what we want to illustrate is if you don't fit into one of the boxes today, and you may tomorrow, those options would be out there and available for you. But for today, it's fair to look at where you are, what your goals are, what your growth needs are, and then get help getting matched up with the right funding source.
All right. Well, we work with all of these different options, or charter school capital has assisted schools in all of these areas, and I'd reiterate the point you just made about there are a lot of options available and they weren't many years ago. But as the charter school market has expanded, more and more investors are getting more and more comfortable with the thought that a charter school might last long enough to pay back the money they're investing, which is really what investors care about. As we move along here, we'll touch on a number of questions coming in, and we're going to get to those as we go along. But things to think about or consider when you're considering all these options for your school, some high-level points I think that are worth thinking about. One is a lot of schools and school leaders and boards think about ownership. And I guess one thing to get across here is that for your school operations, the most important thing is to have control of your facilities. To maintain stability, allow for growth, and have this financial predictability for your institution, you want to know that you're going to be at the same location so your parents and students can rely on the school being there, that you're not going to get kicked out either by a landlord or by the school district or somebody else and have to move 3, 5, or 10 miles down the road, which may make it really hard for the families that you have, that your school is supporting, still be able to attend. That kind of disruption can really be pretty devastating to a school. And not being able to control the build out or continued investment in your facility is something you want to avoid. So having control is really important, but having control doesn't necessarily require ownership. So whether you've got, financing in the bond market or financing with a bank or some private party, or you have a lease, a long-term lease provided by an investment organization or landlord, just making sure you can stay is really important, and being able to put money into the facility or modify it as you see fit is really important and valuable. But ownership itself is actually an investment in real estate and should be analyzed that way. If you have to pay twice as much in annual expenses associated with supporting the facility, but you own it 30 years from now, that may not be the right trade-off. But if you can get really low debt service and or rent and be able to operate there at maybe half the rate, that could be a much better deal for the school and the organization overall. Ownership should be thought of as a separate analysis, which is, do I think the value of the real estate will increase over time or not? A lot of the benefits of real estate investments don't apply to charters, or given that a lot of benefits of real estate investments are tax shelters, and as a nonprofit organization, which most of the schools in the country are, they don't really get that benefit. So just important to think about these things as different factors: control, critical, ownership, and option, but it's really an investment. And in thinking about your operating expenses, it's really about evaluating the total dollars associated with having access to that facility, not necessarily the advertised percentage rates. The financing industry as a whole, we tend to communicate things in terms of rates. And those can be very misleading if you have either very high transaction costs or other covenants you have to comply with that may result in additional expenses and or legal costs associated with the transaction. The entire picture of how much are you spending upfront and on an annual basis is important to think about in terms of dollars, since you pay teachers with dollars, not with percentage rates. The third factor, I think, and we're going to get into more of that in comparing the options. The third factor is cost is not really just money, particularly for growing organizations. Management time is probably your most valuable resource, and some of these things, different financial structures and options, take an extensive amount of time to develop and commitment on the part of management. In fact, any and all forms of financing or a facilities move or expansion really is pretty burdensome on the management team and can be on teachers and create disruptions for your organization. Those are things to think about. In addition to, finally on this chart, comparing the structural constraints and impact on your future growth options or modifications are things to think about when you look at and compare any of these different options. Before we move on to comparing the different structures, Dick, anything you want to add or enhance on this?
I think we're going to talk a little bit more about kind of the varying complexities of the different financing options, and bond financing does certainly have additional complexity to it. There's some benefits associated with that, but your point about management and organization engaging in it is really well taken from my perspective, because I think any lender or funder wants, what we all want is successful operations. So an operator should look at and measure carefully what's the most important thing for the school when it comes to the facility, and I think you've highlighted that in the whole control versus ownership. I think the point is you need to delve into it and determine what's the best in the interest of the school.
I'm going to pop back just for a second to a number of questions have come in that I want to just touch on very quickly. One of the questions that came in is, big versus small. What actual numbers would fit into what's large or small? And I think it's not necessarily about the size of the school. For instance, it may cost more to build a school in New York City than it would to build a school in Columbus, Ohio, just because the land, the building materials, and the labor are very different. So the project's going to be much more expensive in New York City than it will be in Columbus, Ohio. That said, the dollars per student paid, the revenues for that organization will also be a lot larger. What's important to note here is the size of the financing is the key metric, and that has to do with the interest of any investor or investor group to get in, due diligence, or do the work to raise the money. So Dick's organization, for instance, could raise $2 million for a school, but the transaction costs associated with it, the legal costs, the workload, and the compensation to an organization like Dougherty would end up being so small that the expense to the school and the compensation to the various parties in the transaction, the expense to the school is very high, and the compensation to the parties doing the work is very low. As such, it's about the size of the funding, which may be a function of the size of the school, but could also be a function of where you're located and other things. But it is about the dollars being raised that drive that. So I just want to be clear about that. And another question that's come in relates to what's the optimal level of revenues or investment to make in your facilities. And I'd say the answer to that is a couple things. First, the revenues being considered are really all of the revenues coming into the school, state, local, federal, everything counts. That's reliable, government revenues. Financial organizations or institutions thinking about funding your school tend to consider philanthropy as much less reliable. So although it's still valuable in its revenue to your school, you probably don't want to consider it in thinking about how much you could afford, because investors will tend to discount that. But any government revenues that are sustainable and continuous are things people will think about. And in terms of the optimal level, that's really going to vary depending on the environment. So California, for instance, is a market that has very low dollars per student relative to the cost of real estate. Those organizations tend to all be funding in the 20% range on or spending that kind of capital on their facilities. If you can get in and get a deal where you're at under 10%, that just creates an advantage for your school. On the other hand, if you're in Michigan or Ohio, schools and organizations tend to be spending less than 10% sometimes on their facility. Sometimes that's a management choice to go with a cheaper operational facility, but you can certainly spend a lot more and people will fund it at that level. But I think it's really thinking about what do you need for your organization, and optimal in terms of percentage of facilities cost as a percentage of your overall revenues, ongoing revenues, is a function of management's decision, what the market is willing to support, which really is rarely above 20% ongoing, and a function of what keeps you competitive. So I think it varies depending on your market and the type of organization you have, and what you're doing on that front.
And what I would add there, Stuart, on just kind of an optimal analysis, all those points are really well taken. I do think realistically for any funding, any operation, that 20% number is a pretty high, hard threshold, simply because everyone wants the charter school operator to be successful, and in order to do that based on the state funding and the reliable revenue sources, the majority of that obviously has to go to the school and the education first. So to answer the optimal question, I also think there's another balance in there, and you've illustrated it well. The balance actually comes down to what kind of quality facility you can get delivered in the market you're in. And so what we've seen, what Charter School Capital's seen around the country, illustrated by Stuart's comment, the market you're in will in some way help drive or determine that optimal number, because the quality of the facility and the cost of the facility in Georgia, Athens, Georgia versus New York City, there's going to be variance there. So operators need to be aware of that as you look at answering that optimal question.
So with that, I'm going to touch on high-level options, and first I'll say this, as today, because we have Dick here with us, we're going to really go deep into the bond option. I did want to highlight some of the other alternatives and things to consider when you're comparing various options. And there are 4 core options we've listed on here for a school. Across the top of this chart, you can see all cash, traditional bank financing, the bond market, and long-term lease. Now, schools contact us all the time, say, or we'll ask questions. They say, "What about a new market tax credit?" Or "What about the state bond?" Or the rural development funds? Or EB-5 money? Or everybody has some thing they're calling about saying that's specific that doesn't fit. They actually all really fit into these core categories. They're different versions of these basic elements. So let me talk through for a moment, framing the way to think about the options for your school or organization, and then Dick and I will try to compare these different options. And the categories or set of comparisons we're making are across the elements on the left side of the chart, these criteria. So how much cash do I need to close the funding or to get the project executed beyond the financing? The annual cost, and for this example, we're using specific numbers. These are not the actual costs your school will be in a different situation. Rates are, as Dick said, change every day. So we've used the small print at the bottom describes what we're doing, but this is a $7 million example. Most of the rates listed for all options, leases, bonds, and banks, they may be higher than you're experiencing if you're a very mature organization. They may be lower than you're experiencing if you're a younger or smaller organization, or if you're in different markets. But this is a good comparison of kind of the way these different options would lay out. We're also going to look at underwriting criteria and how those change and vary depending on what structure you're looking at, the security interest or collateral that you have to put up, that's committed to the financing, the flexibility for growth in the future, and then other considerations to think about. And so as we look at all these options, I'm going to focus on the other three, but I'll mention how they compare as we'll move across this. Cash. So first, this option isn't really available to most schools, but I wanted to highlight it anyway because it's a way to think about things. If you happen to be sitting for a $7 million project on $7 million of reserves in your organization, of just cash on hand, you don't need to ask permission or go through an underwriting process. You have no ongoing annual cost associated with financing because there's no financing. You own the collateral completely. You don't have to put that up to anybody else. Your growth options are completely flexible, but you have to have the cash to build in the future. The constraint is really about, do you have the cash? Most organizations don't have it, and Sabrina Ayala, the CFO, Chief Financial Officer for Green Dot Schools in California, or now they've expanded to a few states, a very large organization, more than $100 million a year in revenue, serving thousands of kids at, I think, 25 plus schools now. She said they actually did a deal once where they just took the cash they had on hand, they did it. And she said it's easily the worst transaction they ever did in school history. So for those of you who dream that maybe you have the cash on hand, even if you had it, you would still likely want to finance or use somebody else's money because you can put that money back into your organization. Which leads me to the bank option. The bank option is the cheapest way to go in terms of ongoing operating expense compared to either a long-term lease or the bond. But the reason for that is you have to put up 30 to 40% of the money yourself. So for a $7 million project, you'd have to have $2 to $3 million of cash that you put into the transaction that you can't use to fund your teachers or academic programs or other things. That would, in this example, end up being $350,000 to $700,000 a year, depending on what the rates are and how much is advanced. But again, to get approval for that, you're going to generally need to be a minimum of 5 years of operations. You're going to have a surplus or ongoing operating, effectively profitability or surplus for your organization. The underwriting will consider the value of the property and your ongoing revenues. You have to commit the entire real estate facility as collateral plus all of your other revenues and assets. Your growth options will be constrained by the likelihood that the bank would allow you to refinance or some other bank would take it on, and you'll have interest rate risk when you go to expand. The other thing is the terms on bank financing are not as long on the payback of the principal as the bond market is. So you could be as short as a 5-year term or a 20-year term. And so if you're thinking about it, even if you've only borrowed $3 to $4 million or $5 million for the property, you have to pay that back. If you're paying back $5 million of borrowing over 5 years, in addition to the interest expense, you're going to pay back $1 million a year in, the payback to the bank in principal. Now, most of these tend to be closer to the 20-year than to the 5-year, but it's something to consider. Even though it's cheaper in terms of financing costs, your operating costs may still be higher. The bond market, I'm going to let Dick delve into in detail, but you can see some of the constraints. Generally, if you qualify, the interest rates are lower, transaction costs tend to be higher. There's a heavier roadshow or workload associated with getting approval. You do have to commit all the real estate and revenues. Again, to Dick's point earlier, you're going to really need, get your charter renewed before you qualify for this, whether that's year 3 or year 5, depending on your market. And you may or may not want to consider getting a rating. There's some upfront cost for the school to complete design, architectural plans if you're doing a build, what have you, get approval, spend some money on the marketing, and Dick will get into that in a minute, or legal expense. And the last option is really much more prevalent today than it ever was, which is there are other investors now who consider charter schools to be strong long-term risks and tenants, and the long-term lease market is now much more prevalent. The cost to get into something there is really quite minimal, could be as low as nothing other than your time. rates have improved pretty drastically there. They tend to be higher from a cost of funds standpoint than the bond market, but there's no principal payback. The landlord or the investor continues to own the property, but you could have access to it for 20 to 40 years now. People will commit to leases. The minimums, you tend to be able to get into a long-term lease earlier, before renewal. Academic success is a critical element, just like all of these options. This option tends to be very flexible. There's no security interest. You don't have to put up any of your revenues or commit any of those things typically, because the landlord still owns the building and land. It tends to be more scalable and expandable in the future. And just like the bond market, it's 100% financing. But as noted, there's no amortization of principal because the investor still owns the property itself, but you have total control over it long term. So with that, Dick, before we transition into going deep into the bonds, is there anything you'd like to say about the other alternatives? I want to leave you time to really go deep into the bond example.
I think this slide does a good job of stratifying the different options. And secondly, I would say the really good news is over time, we have seen all of these options grow. So there are more funders on the long-term lease side. There are more bond investors. That market has grown considerably in the last 5 years. We're going to talk a little bit more about that. And there are more banks, which is really good news for charter schools and operators. The slide really talks to some key points. And I would describe it as finding your sweet spot. So when you talk about growth options with the leasing mechanism, scalable, expandable, if that's your sweet spot, that's where you should be looking for your financing options. The bond market tends to be permanent fixed rate capital. So there's a lot of reliability to that, even though the trade-off is, as we say in the business, jumping through the hoops to get there. So those are the comments I would add for operators to, as you stratify your options, and these criteria that Stuart's laid out is one way of doing it. It helps you evaluate your own operation and your own sweet spot for the future.
So let's dive deep into bonds. There was a question somebody asked how you go about finding somebody to provide a long-term lease option. We've got actually a couple questions on that, and the answer is I'll shamelessly say call us. We have many of those alternatives. Actually, we have hundreds of millions of dollars invested from real estate investors around the country that are now dedicated through charter school capital to funding schools. So that's something we're excited about providing, and to the extent that option doesn't end up working best, we have a bunch of other parties, direct banks and DIC and the bond market for those schools that are ready for those things, or where the efficiency makes more sense to go in that direction. But definitely have those options available through charter school capital if you are looking for some kind of long-term lease program or expansion effort there. With that, let's transition to the bond market, because I think if you go to a charter school conference at the various states around the country, probably the most prevalent thing you see is Dick and his colleagues around saying, hey, talk to me about a bond. And that has been one of the most prevalent forms, or certainly well-known forms of financing in the charter school space. And according to LISC report released this past year, since the 90s, 12% of charters across the country have received bond market financing. And important to note here that, and Dick will get into this, it's really increased significantly since the 90s and even a decade ago. Much more activity in the bond market overall. But as noted, bonds fit really well for larger, more mature charter organizations that, as Dick describes it, permanent facilities are sought, where it's fixed and it's done and it's built out and you're ready to go. Obviously, there's a need for the other 88% of the market that has not been served or isn't served by the bond market. And those alternatives, as noted, they do exist today, serving the remainder of the charter school market. For any of these, whether it's a long-term lease or the bank or the bond market, it's really for your school and your organization to evaluate what's best for you. If you expect you're going to be expanding and growing, then bonds could be constraining, but bonds could also be the least expensive route for you to go to stabilize your organization. So those are trade-offs you need to think through as you go into it. And with that, I want to turn it over to Dick now to go deep into what's available in the bond market today.
Let's just stay on this slide for one more minute, Stuart. Just as background for listeners, the bond market, the tax-exempt bond market in the United States, is a very large active source of capital. First and foremost, it's been the primary source of capital for public school facilities forever. So the traditional school districts obviously are active and in the bond market and have been for a long, long time. As the charter school movement began and has grown, for certain projects and certain operators that fit, we think the bond market is a natural source of capital for facilities. In some sense, just because it matches up with that traditional public school facility mindset. So the comment there is there are active investors who understand public school education and now understand charter school education well over the 20-year history. And that's recognized in the LISC report here that shows over time we've now seen about 12 to 14% of the charter facilities get funded with bonds. I'd put another number on that, which is kind of a nice number for people to know. There are probably around $3.5 billion of outstanding bonds for charter school facilities in the country now. So that, compared to 10 years ago, that's a much bigger number. So the market is coming to the table with good solutions for the projects that fit. And then the trade-off on that is in your slide also, there's still room and need for the balance of the operators to find good funding sources, which may not necessarily be in the bond market today. However, we often tell people at some point in your life cycle, successful schools are going to be, at some point in the life cycle, likely to be a good candidate for the bond market. And then if we're to move to some of the more detail on the following slides, what I want to highlight here is just kind of some general conditions, criteria, important considerations for bond financing. And then I'll get into a little bit more. We actually have a market that's stratified a bit in that over time, all the underwriting has been able to get some projects rated by the national rating agencies, and we'll talk about where that adds value. But in general, I think we've touched on this a little bit. The bond investors would like to see minimum operating history, 3 years, and that includes audited financial statements. And in some states, that's going to tie or not tie to your charter renewal. Some states enjoy long-term initial charters, 15 years. Some states do not enjoy that. So there's charter renewal risk, and bond investors need to get comfortable with that. And in general, bond transactions like to see at least one renewal before investment can be made. The next bullet point talks about what I call the 4 big areas, and we talk about this a lot and belabor it, and I think it actually relates to any funding source, and it is the general credit qualifying criteria for a charter operator. Operators and your success are going to be centered around 4 big things: academics, delivering academic performance to students. That's why you're chartered and why you're around. Demand and enrollment, and that goes to the state funding sources and your ability to generate revenues to cover operations, including facility costs. So on the bond side, people like to see established enrollment bases, and they'll ask questions specifically about things like retention. Year over year, how many students are returning to your program? Governance and management, I would say, Stuart, has become a more important aspect for bond underwriting criteria over time. And as operators, whether it's a sole operator or in an EMO or CMO structure, the success of the school can be measured in some part by the operator and the governance. And one thing I would add here is that silo, if you will, what also gets evaluated is the relationship with the authorizer. So as we go around state to state, there are different methods and forms of authorizer and relationship with individual charters. So those two get reviewed as a criteria. And then not lastly, but equally important, is finances. As we've said, the bond transaction is more complex, and it will look at specifically at metrics like fund balances, reserves. Measured here is a positive NOI or net operating income, and that's all about the bond being able to demonstrate coverage over and above the debt service. And lastly, bond transactions are really foremost focused and for facilities and not working capital. So those schools that have other needs for working capital, there's other sources out there in the world like charter school capital and others who work on that end. The point here is the bond transaction is permanent funding for facilities. So that's kind of an overview of the general criteria.
I think, Dick, as we move into the detail, a couple things. First, for those of you interested or who can stay, today we'll probably run beyond the top of the hour by about 15 minutes because I think some of the content here that we're going through and the update on the market and some of the things Dick has to share are worth continuing. For those of you who can't stay on, the presentation and the audio is available at the link that we mentioned earlier, and so you'll get a follow-up email afterwards to click on that. So I want to let everybody know that. And also on the note about working capital versus funding facilities, often bond financing doesn't work very well with another lender who might be providing you financing for working capital like a local bank or credit union, because they're all trying to access the same collateral. But charter school capital and Dougherty have been successful at getting our working capital tools that you can use to fund computers or furniture and fixtures or marketing to expand enrollment or all of those things that you may need ongoing growth capital and working capital for. We've been able to get those structures built in that allow the bond to provide the permanent long-term financing and for you still to have access to working capital needs through charter school capital so that those things can work together. And that's, I think, using the different tools available in the market for the things that they're best at is a good way to think about things. All right.
So this slide would tie to the benefits of those general criteria for bond financings. It is long-term fixed-rate capital. It's 100% financing. Stuart made a good point about some upfront costs for bond projects, which may be architectural fees or some development costs, but in most cases, those can all get recaptured or reimbursed in the bond. One important outcome to understand here is the bond investor and the bond transaction is really focused on the cash flow of the school and not the real estate perspective, which would be measured by LTV, which is an acronym for loan to value, or LTC, which is another acronym for loan to cost. So when you look at other options that are more directly real estate driven, loan to value, loan to cost, as Stuart commented on, ownership as an investment, those types of things. The bond market is really focused on the cash flow and the borrower's ability to repay on an annual basis that debt service component. Bonds do work for what we see as all general aspects of the charter school facility need, be it acquisition, new construction, or any combinations thereof. And I think also those borrowers who choose to and do access the bond market, they're actually creating a credit history for themselves in again, what we would consider to be a very large, sophisticated market. And the point in that is it generally allows borrowers to have access to bond financing over and over, particularly when they've been successful with their first efforts. So the next slide would talk a little bit about the trade-offs. And we've talked certainly that the bond transaction isn't necessarily for everyone, although it has evolved over time and we've seen greater access to the market by more operators. But specifically, to give you some specifics here, there are more parties involved. I would tell clients and prospective borrowers you'll get to meet a lot of lawyers if you're involved in a bond transaction. And that's not necessarily bad, but the transactions are heavy on personnel and legal involvement. There's usually at least 3 lawyers for every side of the transaction, including the borrower. They do have higher transaction costs, although again, in most cases they get rolled into the transaction, but they are higher costs than other financing forms. So those need to be measured against the other options. When you're in the market, the transaction itself would typically be issued through a conduit issuer. This is going to vary state to state, Stuart, because some, under the government organization, some charter schools in some states like Michigan actually have an ability to issue their own debt and don't need to go through a conduit issuer. But in most cases, an underwriting would take place through a local municipality or a housing and redevelopment authority, that type of thing, which are active participants in the market. But borrowers need to know, in simple terms, there's always another party involved. It is a longer funding process. We usually tell clients from start to finish, reasonably, you should think about a 6-month time frame to get a good, efficient transaction completed. There is direct review and approval from multiple investors. And Stuart, to go back to your example, even a $10 million bond issue might have several investors involved, and each of them would do their own due diligence on the transaction and maybe be even involved in meeting with management and reviewing the project directly. A couple of other trade-offs or challenges to the whole transaction aspect. The bond transaction and underwriting will ask and generally require that a borrower live up to covenants. Those include things like debt service coverage, which would be annual positive net operating income to provide debt service on the bond, and there are a variety of other covenants, including reporting on academics, reporting on enrollment, those types of things. So it's just really good for people to know that when you get involved in these types of transactions, there are generally some additional considerations that management needs to know about and adhere to make it successful. Having said all that, we've referenced the fact that it's become a very active, large market, and on every side of the transactions, underwriting, investment banking, real estate, suitable funders as partners for things like working capital, there are a number of solid professionals out there in the marketplace who can help borrowers overcome these challenges. The next couple of slides get a little bit more into specifics on current trends. I'm going to talk about non-rated bonds. In the big picture of tax-exempt bond world, still the majority of the transactions are non-rated. And then I've got one more slide on the rated aspects, which we'll talk about next. Non-rated bonds, issuance continues to increase. It's definitely increased more in the last 5 years. We have seen transaction sizes grow. I think it's fair to talk about an average size now is around 15 million. The key metrics that are involved, and this is good for borrowers or potential borrowers to hear, what's driving now is a measurement we use in the bond market that's called the days cash on hand measurement. It's actually borrowed from other nonprofit enterprises, hospitals, higher education, those types of things, where you can measure the operation by, if it's a $4 million annual revenue operation, you divide that number by 365, and that equals 1 day's expense requirement to operate, and that turns into a day's cash on hand metric instead of a fund balance. When you look at financing and lenders, others may talk about a 5% fund balance, but nowadays the measurement is driven toward this days cash on hand metric. I think the other metrics that have evolved and become more important are that authorizer relationship. And clearly, and we've seen this in the marketplace more recently and ongoing, transactions do require very, very good disclosure or reporting on academics, because it does get measured, and that includes demographics on your population base, as well as outcomes on your test scores, as well as progress reporting on test scores. So operators need to know that that has become a more important variable to access the bond market. Last couple of years, in talking more about current conditions, what we've seen is a lot of refinancings, and that's been driven by interest rate market and lower interest rates. It's driven a little bit also by the fact that other financing mechanisms that are out there, the bond market can be an option for a refinancing or a takeout, whether that's a development loan or something else that's in place. And then I think my next one and last slide talks just a little bit about the rated aspect of bonds. So if we divide the bond world into two, there's non-rated, which really requires investors to do their own due diligence and analysis and review of a project. And then there is a bond rating available. The majority of the charter school bonds that are being done have been rated by Standard & Poor's in the last probably 10 years. We're now seeing Moody's, which is one of the other national rating agencies, get back in the business, and both of these groups would provide an independent letter grade rating on a bond, and that adds an independent valuation to the bond investor when they can look at a rating on a transaction and get some specific credit information about the bond that way. I think the key points to know here is the rating agencies have solid, good metrics out there that a borrower can look at and measure and see if they fit the model, if you will. To get to an investment grade rating, which would be a bond that would stand in on par with kind of a traditional school district bond, we've seen those rating criteria move to larger population size, what we call measurable metrics, and a couple more acronyms here. The DCOH is, again, the days cash on hand. That is all about how much liquidity an operator has to cover its costs. And then the last one is very bond specific, MADS. That is a term that's defined as maximum annual debt service. So the rating agencies would measure the bond transaction against the largest single annual payment out of the 30-year term of the bond. And then lastly, we're seeing more of the investment grade ratings kind of move to the larger CMO, EMO, or obligated operators who have maybe multiple sites. So a little bit of something for everyone on both sides of the market, and a fair amount of specifics that we can get out there in front of people, but also address specifically if needed.
One question that's come up, Dick, could you, I know you noted that transaction costs get rolled into the financing, but one of the questions that's come up is, for the example, $15 million average transaction size on the non-rated or for the rated, can you just give a ballpark of all those the legal brokerage, the transaction costs associated, or a dollar estimate for an average $15 million transaction for the
Sure.
rated,
I think we would call those soft costs on a transaction, and their financing costs primarily legal costs, underwriting fees, real estate due diligence, be it appraisals, phase one reports, those types of things, or structural analysis. And some of those, any lender or funder is going to want to have a project do also. But I would say for the group, the ballpark for a $15 million transaction, those total soft costs and financing costs are going to be around 4% of the total number. We've seen those costs come down over time as providers have gotten more sophisticated and educated. But I think that's a fair number to consider as an all-in kind of cost, overall cost.
So $600,000 for a non-rated, and is it more for a rated transaction?
There'd be a rating fee itself. So there would be additional costs to get a bond rated. And again, there are some trade-offs to that.
Right. That may end up with a lower rate.
Correct.
Okay. Thanks for that. There are 2 pages here for everybody that summarize this comparison of the different options, and they're done in the form. One is on page 19, a $5 million or a small project against the 4 options we described, and then a $20 million project or a larger project are compared, so you can see how things change. For a small project, the way to think about it or take a look at this chart is red light, more difficult, yellow light, easier, and green light, what you'd hope for. So for a $5 million transaction, given that long-term lease and bond are 100% financing, those are green. Traditional bank is less than that, so you need cash on hand yourself for 30 to 40% of the transaction, and then obviously doing it all cash is red because most parties don't have that. It's very difficult to come across that. On an annual cost basis with no financing, it'd be great cash-wise because you don't have ongoing financing costs. So the bank, you're financing less. Therefore, regardless of the rate, it ends up being green. The annual cost of a bond for a small transaction is higher for a variety of reasons. As we mentioned, some of those transaction costs are largely fixed regardless of size. And then long-term lease is better, but because you don't have the principal amortization that you do in a bond or a bank, but and you do have 100% financing, which is why it's not as good as a bank or all cash. From an underwriting standpoint, difficult to qualify for bank financing and or the bond financing relative to a lease. Security interest we've discussed. You have to commit all of your interest in the bond, making it more difficult. A lease, you don't have any revenues committed and have flexibility. And on the growth options, same thing. Long-term lease, you can go back out and just get some small incremental piece without having to redo the entire transaction. A bond financing, you have to refinance the entire transaction, and you may be constrained about that, often with a lockout period. For a small project, bonds are very difficult or expensive, may not be available option. Lease is very prevalent today, and bank options for smaller projects are also something to consider because you may have the cash available. As you switch, though, and go to a large project, the little boxes show the 5 values that change. For a large project, the underwriting, the annual cost of the bond becomes much more efficient because of the lower rates available in the market. The lease annual cost is still often competitive because there's no principal payback or amortization. But for larger projects, bonds tend to increase the efficiency depending on what the rates you get across these. For underwriting, a larger project, it's still heavy-duty underwriting for the bond. In fact, most banks just won't be able to fund that at all. You won't clear their credit committee because it's too large for the bank to do. But long-term leases are readily available and probably have the lowest underwriting hurdles across all of these, an easier process. Security interest is no change, but on growth options, the reason that the bond is yellow for a larger project, whereas it's red for a smaller project, is even though you might have a 10-year period where you're not allowed to refinance, if it's a large enough project, you may, and you're just refinancing potentially with the same investors, parties may be willing to do that, even though the covenant says it wouldn't normally get done. Those constraints don't typically exist in a lease. You can expand and grow, and just on a $20 million project, maybe you need $2 million to add classrooms or gymnasiums or something. You can often get that from the investor or landlord who's controlling the property. So this is a framework or simple way to think about these different things. Obviously, every transaction varies, and you need to look at the details on all of the options available. But it's I think Dick and I, as we went through it, think this is a fair assessment of the various options given the different sizes of the projects. Dick, as we're getting to the tail end, there's a bunch of other material I'm going to flip through just so people see what's there.
Sure.
But anything to add on this, or should we move to the remainder?
I think we move on.
All right. Dick mentioned a bunch of things about funding approval, and I'd say they apply to everything. And on page 22, there's a summary of how to get approved for any financing. Every investor, every funding source cares about the demand, as Dick mentioned, but really as measured by your enrollment, whether it's waiting list, expanded grades, market growth potential, but everybody wants to see stable and increasing enrollment. School leadership history as measured by really the leadership team's track record, but also your ongoing academic performance, particularly compared to local options, whether it's the district or local peers, or how you're performing relative to state averages are important. The financials, as Dick referred to, the numbers have to pencil to make sure the school can afford it ongoing. And that could be a function of the various metrics that Dick mentioned, but everybody considers the value of the property, the ongoing percent of revenue being paid for the financing, and make sure the school has sound financials that can support it long term. And the governance issues, authorizer relationship, and just generally having audits that say you're operationally excellent and adhering to internal controls. All of these things are around ensuring that you're a viable entity long term. That's what people are looking for. Considerations on any project beyond just the financing. These are complex transactions, and if you're adding on to that the build out of a facility or a move, it really involves significant planning. You have to be planning at least a year out for what you're doing here. You can keep an eye on the market for what's going on, as Dick referred to during the discussion today, rates and available products. Pay attention to what's going on out there. Sometimes there are better opportunities, or timing is right to consider refinancing or expanding from a financial standpoint. When you do it, make sure you have all the internal resources lined up. Your teachers will be affected, the families, the programs, your academic leaders, the on-site management will be affected at the current site, and the executives running your institution will spend a lot of time with financial parties and or builders if you're going that way. And so make sure you prepare for things in advance. If you are acquiring land, designing and building a facility, there are plenty of parties out there, developers and construction organizations that we work with and that exist serving the market today that have a lot of expertise and experience. The execution of these is very complex, and trying to, quote, do it yourself, unquote, by hiring different parties for every function can be very complicated and financially risky, but also really quite complex. And getting experts to have done this before across the board can be useful and helpful to achieving long-term financing from any party, including the bond market, who will look to make sure you have parties that are engaged in this that have expertise and a long-term track record of success, like your school. So choose a strong partner for that, whether it's a full-service resource that can provide funding and development, architecture, contracting, et cetera, or a party with success in the financing area, and then paired with somebody who has a great deal of success on the development side for the individual property. There are a number of things to think about there, but one consideration also is, as Dick noted, to the extent you're getting real estate funding, it's just real estate funding. To the extent you need financing to expand and grow, engage in marketing, or deal with the technology and furniture and fixtures and other elements of the property that are not permanent, or for advanced funding against programs, working capital and growth capital are available from other sources like charter school capital that can help with that too and pair with your long-term financing with the real estate. And so those are things to keep in mind. I'll close out or just mention that there are a lot of options out there. Long-term lease we mentioned, a state bond, which tends to be the cheapest, but also you end up having to wait in line maybe for 5 years in some cases. CDFIs, which are nonprofit financial institutions that are funding certain development areas in the country or local regions that have funds available. They operate much more like a traditional bank, not providing 100% of the financing. The private bond market, which in some of the stuff Dick has talked about relates to that. Funding out of your own cash reserves, new market tax credits, EB-5 money, which is related to foreign dollars investing to get immigration access, and the USDA has rural development funds, which is federal money to subsidize the growth and expansion of rural schools. All these are available, but they're really all captured in the things we've covered today, and we're available as a follow-up to the extent people have questions about these options or others. Please feel free to reach out to us via email. The phone numbers are listed here for me and for Dick. And as a reminder, the presentation, including the audio and the PowerPoint materials here, are available at charterschoolcapital.org/webinars. And you can just, you will be getting an email follow-up for your registration today, where you can just click on the link and get all the materials and or forward it to others to the extent you think it's valuable and helpful. I wanted to say to everybody, we really appreciate your attendance today. Dick and Dougherty want you to know there's this legal disclaimer available for you to read and review in your time. That said, it's been
I want to thank you too, Stuart, for allowing us to participate, and we want to thank the audience again for listening in and checking in, and assure them that in the current status of our world, your business model, bonds, and whatever the options might be, there is a lot more available for you and your operation today than there ever has been, and we encourage you to seek it out to help your program grow and meet its mission and vision on the facility side.
And I want to say it's been a privilege having you with us today. I think given the attendance today and people staying over, there's obviously a lot of interest and I really appreciate you joining, and your insights are really incredibly valuable, and it's been a pleasure to have you with me. So I want to thank everybody for joining us today, and we look forward to working with you all in the future. Thanks again, Dick, for joining.
Thank you.